let's go to the details of the value for money assessment, public sector comparator calculations and its adjustments. So here we start discussing different approaches. Okay, the raw PSC estimation, the net cost components under possible differences in PPP. Okay, so possible differences in the costs that I am considering in the PSC versus the PPP. Okay, so we will talk about the CapEx based cost, OpEx based cost, and other costs. Okay, first of all, nominal values. The most common is they are applied nominal values in both models projections. Some countries use a couple of countries in Latin America, 3 countries in Latin America. They use real values, okay? But the most common, and I consider better practice, is nominal values. The PSC cost always will refer to the same project, same technical requirements than what will be considered in the PPP projections, okay? Yet it is common to include efficiency cost reductions in the PPP and contingency premiums. So the cost of the CapEx, I mean the CapEx and OpEx estimates are not going to be the same. They should not be the same in the PPP. They should incorporate contingencies from the perspective of the contractors that are getting some transfer of risks from the SPV, and the price for that transfer is contingencies in the price, but it could be some efficiency cost reductions. Okay, you see the tick here is things that are like or consistent with the CP3P. These are things that are different or not consistent with the CP3P guides, which doesn't mean that it's bad practice, okay? In relation to major maintenance, sometimes it is made an adjustment to the residual value, for example, in UK. And it's something that we are advising to implement in Colombia, for example. And they have it already, but we are sophisticating a little bit more. And I think they have the same also in Peru, in Latin America. So in the end, same project is not, and same base case is not completely true. This is an exception sometimes that we can admit. The point is, okay, let's assume that realistically speaking, I am convinced that in the reference project, if I have to handle directly the reference project in a conventional contract or contracts, I will not be able to secure the funds every 10 years to make the reinvestments and renewals that I should do to keep the asset in good condition. Rather than in the PPP that by definition I have secured the funds because I have committed during 25 years these amounts. So meeting the renewal plans in the PPP is going to be much more reliable and certain than in the PSC for many countries, mainly emerging economies, but I would say also in Spain. So why don't recognize this? Why not recognize that in reality I will be missing some renewals? And if I miss some renewals, or let's say I only do 60% of what I should do every 6 years, 7 years about investing in major maintenance, what is the conclusion of that? Conclusion of that is deterioration. I mean, everybody knows that if you don't maintain properly, it's not that after the 20 years of the period or whatever, you need to put the money that you didn't put. You need to put the money that you didn't put multiplied by a number of times. Okay, so this is the philosophy of this adjustment to the residual value. A money to be recognized that you will need to put at the end of the contract to recover and compensate for all the escalated deterioration coming from sub-maintenance or under-maintenance during the life of the project. And I like it, okay? And then something that is more or less similar or different sometimes to the CP3P description is transaction costs and contract management costs. Sometimes they are explicitly included in both models, so you don't need to adjust. Sometimes they are not included at all in any of the two models, like in Korea. In Korea, they are not incorporating transaction costs, neither monitoring costs. They are considering that are the same, so they are neutral. Okay, so this could be like assuming that this is a reward for the PPP projections in favor of the increased quality assurance that we could expect. Okay, we will discuss about this later on. When we talk about adjustments, we will come back to this. Okay, still in the raw PSC estimation, what about taxes? Okay, this is pretty much in the real life. Basically, all of the countries that I saw, they include taxes in both models. Okay, the projections of the costs, payments to be made by the government are incorporating the taxes in the both models, PPP and PSC, and then making an adjustment for differences. So higher taxes that are implicit in the payments to the SPV, sorry for the E, it's in Spanish. So payments that I am doing to the SPV are not a real net real cost to the government. Neither of the payments for taxes as a cost of the contractor is a real cost for the government because that money is coming back. No? So I need to neutralize that. But some countries do not include taxes at all, even they don't include an adjustment, which I don't think is good practice. Okay. All right. It is considered best practice to use nominal with taxes. In relation to replacement, renewals, major maintenance, and the residual value adjustment, we will discuss later. When I am putting a double asterisk is that, I mean, we like it, and it's not contemplated in the CP3P guide. Okay. Transaction costs. We believe that it's most appropriate to estimate them specifically in each model, transaction costs. But so this is consistent with the CP3P guide. But the contract management cost, the monitoring cost, I personally believe now that the most appropriate is to assume that they are the same. Okay, so I'm diverting from the CP3P guide now, or just do not incorporate it in the analysis, unless the country allows for a material consideration of qualitative analysis. Because generally speaking, probably is going to be higher the cost implicit in monitoring and contract management in the PPP for the government than in the other route. But it's not fair to penalize the PPP for something that is a mechanism that is creating value. It's value for money, that money. I mean, the extra money that one could consider that is going to commit to controlling the key performance indicators and making payment deductions and so on in the PPP, because in the PPP contract, everything will be more detailed, the performance requirements, etc. Typically, it's not fair that is going to be penalized in the PPP when by itself that money is giving me in return higher quality control. However, if there is in the methodology of the country a very clear space for qualitative assessment, maybe I should reflect the true reality of costs and then qualify this thing that I am saying with a very strong statement in favor of the PPP. Okay, but if I'm not relying on qualitative, as it happening in many countries, I would remove the impact of the different profile of the cost for monitoring. Okay. So double asterisk in my orange boxes, which is my key notes and personal opinion, means that this could be changed or reflected in the CP3P guidelines. Okay. Okay. Inclusion of the income from third-party sources. Okay, we are here. Income from third-party sources. Some countries consider user and other revenues, other commercial revenues, for example, revenues coming from a parking in the hospital, revenues coming from the cafeteria, and user revenues, we mean the true user when there is a charge to the users in a water project or in a real toll road. So some countries consider user and other revenues to be the same. Example, Korea, Australia. So I will put here my projected income, and it will be the same that the income projected for the PPP contract. That is different than in the CP3P guide. Okay, the CP3P guide is different. Well, the CP3P guide, I think, if I remember correctly, says it makes sense to consider that they are different. You need to justify. Sorry, why? Could be different. Could be different because, for example, for political reasons, not justified economically speaking. For example, oh, technically speaking, could I manage directly this project as a realtor project with a public company? Yes, but I'm not brave enough to put this toll level that is going to help a lot the feasibility of the project, because politically speaking, I don't want to put a toll level that is the same level than these other toll roads that are operated by private concessionaires. I want to put it lower. But if I do it as a PPP, I will allow this guy to put a higher toll. So in that case, maybe it makes sense to correct that, but it's very hard. And also, when this is true, and it could be reasonable to believe that the revenue is going to be higher in the PPP case, the revenue coming from users for a higher toll, we need to recognize that means that remember the continuous? We need to go back to the cost-benefit assessment, the original cost-benefit assessment, and reconsider which is going to be the benefit of the project in the PPP case, because the demand is going to be lower, because the level of use of the road is going to be low. So for these reasons, I think it's good to have the same revenue projection. Okay, but they can be different if duly justified, according not only to the CP3P, but also in France, Netherlands, or UK. The consideration of the same income projection of revenues coming from users implies the assumption that a higher income equals the loss of value of the socioeconomic benefit, which makes sense to me. Okay. Same revenue projection should be considered in both cases for revenues from users in economic infrastructure. This is my consideration. Okay, is deviating from the CP3P. In the day that we may advise about the new version, because we were the lead authors, I think that we should incorporate this if other experts agree. However, for ancillary revenues, I mean other revenues, other commercial synergetical uses, I think it makes sense to leave space and recognize that the private party can be better than the government in maximizing utilization of the site. Okay. All right, risk adjustment. Oh, risk adjustment. Some countries only adjust for transfer risk. So we only put an adjustment for the value of the risk for me as a government of those risks that I am transferring in the PPP, okay, to make apples to apples. But I only consider the transfer risk, like in the CP3P, Korea, South Africa, France. However, unlike the CP3P guide, many countries are putting in the risk adjustments the value of the transfer risk and the value of the retained risk as well. But then the adjustment for retained risks should be incorporated as well in the PPP projections, obviously. And in the end, it's going to be neutral. Why? Because we want that information, basically. Because in most cases, we should do, for a PPP, evaluation of the risks that I am retaining in the PPP, because that is what we call contingent liabilities. This is about fiscal management of PPPs, which maybe we do another masterclass, because it will be linked to the course that we are designing, a specialized course on fiscal management. Like, by the way, we are finalizing the design of a value for money full focus course that we will announce promptly. Okay, so all risks in Netherlands, Australia, Mexico, Peru. In UK is different. In UK, they use just an optimist bias, a very simple, straightforward approach to punish the projections of the PSC, considering the concept of optimism bias, which is an approach of value of risks. Okay, generally, it is considered by everybody that only relevant risks, okay, previously identified in the risk prioritization exercise should be assessed. So it's very typical to ignore risks that are not very relevant. By the way, identifying risks that should be evaluated as a risk transfer that deserves to be evaluated is something that is not easy or straightforward. It's not just any single risk that is transferred in the risk matrix should be evaluated, because some risks, there is a perversion if we evaluate them. Okay, let me put you an example. In a risk matrix, I will say availability risk in the availability payments, of course, transfer. But I should not put a value of that risk transfer to adjust the PSC, okay? Because I am not saving any money in that risk transfer. Okay, if we have time, we can discuss about this later on. But anyway, as I advised in the beginning, this course is not going to go into, because it's not practical in terms of time, into details about risk assessment, okay? All right, most developed countries propose wide flexibility in the methodological approach for this risk evaluation or risk assessment, including that they allow for just using the most likely value. Listen, I think this has a 40% likelihood, and that if it's happening is 100, that is the value that I put. That is simplistic approach is even acceptable in many cases in many countries. But then you have the probabilistic assessments and even risk simulation models with Monte Carlo. So the point here is, like the guide is saying, you have a variety and you should have flexibility. So depending on the needs, if risks are very simple, are not so huge, the project is small, do some simple approach to risk evaluation. Just don't spend, that's not value for money to spend many time and money in advisors to go and see which is the percentile, whatever, for this risk. Is not going to make the difference. In other cases, maybe it's worth it. Okay, that is what most of the countries is saying. But not in Latin America. In Latin America, it's very typical to be very prescriptive. No, you need to use a triangular, and here you need to use Monte Carlo. Okay, some countries, mostly in LAC, prescribes always the use of probabilistic calculations, assuming the value of risk related to the high confidence intervals, the percentile 95. This is very dangerous. This is very dangerous because I am adjusting the costs to the PSC, the cost for the public conventional procurement route, by the value of the risk transferred in the PPP. So here is where resides most of the capability of the PPP to create value for money, or the quantitative assessment to say is positive. The PSC costs adjusted to the risk that you are transferring is higher than the PPP cost. That's value for money. The bigger that is this risk adjustment, the bigger that is the value that I give to the risks that I am transferring in the PPP, the value of my probability and the impact going to repaint my card. Remember, that value to me, the higher that I put that value, the more is the higher is the likelihood of the value for money being positive. And how can I consider a likelihood of a risk happening bigger than the percentile 50? I mean, the percentile 50 in a normal, okay, would be this value of deviation of the cost. That is telling me that I have the same probability. Okay, all this probability is 50%, and all this probability is 50%. So I have the same likelihood that with this amount, the P50, which is the median, I have the same probability of overestimating the value of the risk than underestimating the value of the risk. But some countries are getting this value, the percentile 95%. So I have only 5% possibilities that I am subestimating, and have a 95% of the occasions I am overestimating. How can you should not use that value, because you are for sure overestimating the value of the risk. What are you doing in this case? Okay, what you are doing in this case, let me clean up, is biasing the value for money assessment to have a positive result, because you want to approve yes or yes the project as a PPP. Okay, that is what we're doing. Okay, the need to include PSC, the need to include in PSC the value of all risks goes beyond the purpose of the value for money exercise. It's not necessary. But calculating those risks, the value of the retained risk, is good because it's good information. Flexibility in guidelines, okay, in the national guidelines that everybody should have for risk assessment is the best practice. The guidelines for value for money should incorporate flexibility as per the methodologies. Procuring entities should be able to apply judgment in deciding if they need or not for a particular project more or less sophisticated probabilistic methods. Any case, using risk values related to the percentile, I mean above percentile 50, we will be overestimating the value of the risk transfer, creating a bias in favor of the PPP. We are biasing the assessment. Okay. All right, let me just explain one thing here. What is the most of the value for money is here? When this is, remember that this is inside this projection. Okay, this is the projections of the PPP cost, is the payments to the private. Okay, and most of the value for money, I mean, the value can be justified by the difference between the contingencies that the guy will put over the base costs, which is something that the PPP company is charging over the base cost of the PSC. Okay, this, which is not good, is positive because it's increasing cost, but it's negative, is going against PPP, minus the savings of the efficiencies, plus the financial cost, because this is a project finance, and the financial cost of the debt are higher than the public debt. And this is reflecting higher risk that has been transferred, plus the equity return, which is also financial costs, and is reflecting in the rate of return the risk that has been transferred. So you see that here, here, and here is like the premium of an insurance. Mitigated a little bit for some potential efficiencies. This is going to be compared with this. If the value of the risk for the government, of the risks that I will retain here, but transfer here, remember, my $600, because was 2 times per year going to repair the scratch. If this is bigger than the 200 of the extra premium that I will pay to my insurance company, so value for money is 400, is where the value for money is, okay? Okay. PSC adjustments, non-financial benefits. So we saw risk adjustment, non-financial benefits. I already explained this and we are running out of time. So the idea is punish the PSC with an adjustment equal to the benefits that I could be losing in the PSC due to a more reliable construction term in the PPP. That's it, okay? Some countries do not consider this, like France. Many countries consider it, like Netherlands, Colombia, etc. And we like it. And it's contemplated in the CP3P guide. And tax neutrality, that's the other big adjustment for the CP3P. Tax neutrality. So we already discussed this, no? Many countries include taxes in both projections. Okay? So when you are putting in the spreadsheet payments to be made to the contractors in the PSC, to the different contractors, which is including the price of the contract, which is including the tax cost that the guy is suffering, and the same with the PPP payments. And then, because it's bigger, the taxes in PPP than in the other case, I need to neutralize that because they are not a true cost for the society. So many countries include taxes in both projections and then adjust, okay? Some countries leave out taxes from the PSC and from the PPP projections, and then typically they do a simple adjustment later on. Okay, not good practice. A few countries do not include this adjustment at all. In this case, we are not biasing again in favor of the PPP. We are biasing against the PPP because we are overestimating the true cost of the PPP because the tax component is not a true cost for the government. Okay, most common practice, PPP mature countries, is to make an adjustment for differences. And this is good practice. Okay, and other adjustments that are not included in the CP3P guide. Residual value and financial cost adjustment. Residual value, I already commented. Okay, even if it's contradicting the assumption of same project in both models, this is good practice if it's duly motivated. So we are deviating here from the CP3P guide. When I have very clear reasons that this will happen, remember that if I finally do it really as a conventional contract, I will not be able to meet the same plans for renewals, reinvestments, and major maintenance that the PPP partner will do. So that will create an exponential deterioration that I will have to pay for it at the end. Okay, so that is another possible adjustment to the PSC. And the other one that is mentioned in some guidelines is pretty logical. Is listen, if you have a specific debt in the PSC, no, with a higher cost than the government debt, because you are just financing with a dedicated loan with any bank, loan, public debt, negotiated from the government, but typically is going to be higher than the overall debt of the government, the general bonds of the government or whatever. So you need to put this extra cost there. Okay.